Well, the best way to deal with big losses is not to have any. You know, stop yourself out. You know, there's a way to trade the stock market where you just simply say no. Just say no to losses. This is what Millennium does. Many firms just say, no, we're not going to allow our portfolio to go down. You know that's an option, right? You want the risk, that's up to you. But don't cry when it doesn't, go in your favor. You asked for the risk. You wanted the risk, you wanted the reward. Anytime your portfolio goes down 1%, wipe everything out, start again, and make the max leverage you could use, cut that in half. Nobody wants to trade this way. Why? Because we want to gamble. All right? Even though some professionals don't want to trade this way, the professional knows this is probably the best way to do things. Many people basically want to trade their way from relative poverty to independence, and you're just going to impoverish yourself further. If you're okay growing your account 10 or 20% a year, which you should be, thrilled with, that's a good way to do it. Just shut down your account every time you lose 1%. Just shut it down. I refuse to lose, and cut the amount of buying power you can use. But you have to have discipline. And most likely, some position's going to go against you. You're going to say, I know I have my buying power limit, but this is a special. This is a special one. And of course, it's not a special one. That's why I mentioned yesterday, if you can trade with somebody that has view access to your account, and preferably even trading access to your account, somebody you work with, is called a job. You can really do well by that person seeing your blind spots. It's like playing chess together. Imagine if you had somebody say, oh, you're about to blunder, stop. But that's not the way the game of chess works. But in this game, you can do whatever you want. I'm talking about tools that you might say, oh, I can't do that. I don't have a colleague. I can't afford to pay somebody to help look over my shoulders. Well, don't invest, okay? Don't invest. So when you say, I can't, do what the pros do, the right answer isn't to keep doing it. The right answer is to say, let me play a different game. In the stock market, you don't have to go to war with Citadel. You don't have to trade. You don't have to invest. Nobody says, who's whispering in your ear? Take all your money, put it in Rocket Lab. I'll glow too. Quantum stock's even better. I really do believe investing is for professionals. It's not Citadel or anything. I think that if you can define a niche where you can compete and you're a good investor, you really want to do it, and you could do it full time, then I permit you to try to compete. But make no mistake, investing is a competition. If you were competitive your whole life, you're a great sports player, you silver medal at the IMO, you got 2,300 in chess. Yes, let's go. You can figure out a way to compete. If you're a guy who works 4 hours a week, lives with moms, you're not going to compete. Sorry. It's full contact. You can't say, I want to play the touch football of investing. No, 1,800 is not okay. That means that you didn't try hard enough. You gotta, if you're not 2,500 in something in your life, not gonna be easy to make investing. I don't think you need a high IQ to be a good investor. I think you actually just need more discipline and emotional stability. It's not hard to figure out what companies fake. A little practice. I mean, most of the people that fall for like the quantum computing and stuff like that, this is basically their first time investing. Or somehow they've lost all their money and somehow they have some back and they're gonna lose it again. And also look, people do make mistakes. I mean, there's smart people that get caught by dumb stocks all the time. That's not, it's not all the people, but many of the people who were in cassava, I asked them all the time, I said, listen, man, I like you. Just give me a factual answer. Is this your first biotech investment? It's like 50 to 75%. I was like, oh, okay, that explains it. You get to learn. But at some point, the intelligence doesn't help you. I know so many people who are smarter than me that aren't good investors. Your work ethic counts. Your ability to, what are you looking at? What kind of things do you examine? That really matters. Your creativity matters. The actual nuts and bolts of investing it's really not that complicated. I was one of the first users of Transformers, and I didn't make the connection to NVIDIA. All right? Think that through. It seems like you're a very, very big bag holder in INMB. But you can learn how to invest by watching. I mean, the way I go about things are I try to arrive at a fair value for a company. So it sounds like you're what I call narrative investor, which is not what you want to be. The narrative investor doesn't think about price. He just thinks about the quote unquote story. Price is very important when you buy things. In the stock market, prices can determine whether you make money or lose money. So you want to focus on price a lot. But narrative investors, typically amateur investors, retail investors, they focus on the story of the company, which they call fundamentals, but it's really just a story 99% of the time. And they don't, ever, think about, what should I pay for this? If you analyze the value of a drug company, you should be able to come up with, roughly what is this company worth? What would Carlyle or Berkshire pay to buy the whole company? And that's a really good exercise. It's kind of called private equity investing. And you could do this with biotech and speculative companies too. One has to sort of get a sense for price. That's the most important thing to me. Now, IPOs are supposed to be price discovery, right? You guys know how an IPO works? All right, Morgan Stanley, JP Morgan. JP Morgan takes you around, almost like a bride, a father and the bride. They walk you down the aisle. Okay, it doesn't work exactly like that. Let me take a step back. Yeah, so they build a book. It's called Equity Capital Markets, or ECM. You can find ECM people on Godel as well. They build a book. They take orders from clients. The clients participate in what's called a roadshow. Roadshow is the company management team visiting the top accounts, the banks. They'll visit the Fidelities. They'll visit the Capital Research, talking about the top guys in all of Wall Street, Jennison. Of course, they'll visit Millennium and Citadel, GSAM, Goldman Sachs Asset Management, all the usual suspects of any. Look at the holders list of any stock. You go to Godel, type NVIDIA Equity HDS, you'll see they'll visit BlackRock, T. Rowe. T. Rowe's a big one. And the CEO and CFO will meet with these guys, and then the firms will decide. No, Wainwright's a banker, so we're talking about the banker here is Goldman or JP Morgan. In this case, it's JP Morgan. But yeah, they'll meet all the top clients on Wall Street. Everyone will want a meeting, but not everyone will get a meeting. And they'll build up the roadshow, and the roadshow will probably just be in New York, but sometimes it's in Boston and SF, and they'll do a few dates, maybe 2 dates in New York, and then the book gets built, and that's it. Yeah, unboxing. I have a lot of friends. I think that investing isn't about making friends. It's about being right. When I check my P&L at the end of the year, I don't see friends made 17, friends lost 6. No, that's not what I look at. It's not what the IRS cares about either. 3D printing was the same thing as quantum. People thought it was going to be something big. It wasn't. GG. I'll give you a 10% chance to make 10x your money. And they say, that sounds great. Other people say, oh, a 10% chance. There's no way that's going to happen. And for humans, statistics are very hard to parse. I'm not saying I'm right, by the way. For some people, they'll look at expected value and say, I'm just going to do the expected value. But Kahneman wrote a lot about this where, it's very hard to perceive expected value. Most people either bake in an irrational pessimism, optimism, I don't know. But there's been a lot of work done on that, on those mental models. Hopefully some of you guys bought Circle when I bought it and still held it. I chickened out. Couldn't handle that. Couldn't handle the heat. Right. People feel loss much bigger than a gain. I think that around 50% of your stock picks are going to be wrong. You really just have to have your process and let it rip, and that's really it. Because half of your investments are going to be wrong, you have to basically that's the reason you can't marry any specific stock. Like, if you accept you're going to be wrong half the time and you have some loser that is not great, doubling down on that loser is just going to make you lose all your money. There will be stocks you're just dead wrong on. A lot of times the only thing that you can do to avoid a management change is sell the company. The board wants to fire you and you're like, wait, I'm going to just sell the company. And they're like, oh, okay. Okay, so let's say you're right. You guys buy all the stock and it goes up. Now that's what I'm talking about. All right, so stock goes from 20 to 40. Sweet. You guys are doing great, right? Yeah, we doubled up. And we're going to double again until I'm the richest guy in Bama. Understood. All right, so now the bid is 40. and the ask is 48.05.
You keep going to this bid-ask thing. I don't like that.
Right, but the last sale was how they determine if you have a margin call or what your account is worth, right? So all that really matters is what the last price was, whether it traded at the bid or their ask, doesn't really matter. But that's the new price. That's your new worth. If you own 1 million shares, you're worth 40 million if it trades here, you're worth 40 million, 50,000 if it trades there. You can't really change that. That's just how the market works. It's called mark to market. I know I wish I could mark my stocks to whatever price I wanted. It seems like that's what you guys are trying to do.
We just gonna trade it amongst ourselves. Mark this mark this company to 600 a share. Why not? They do it on Wall Street all day. I want to do it too.
I understand. Okay, so let's say this happens. You guys diamond handed it, but what happens to the person that bought it for like 20 and now it's at 40?
They gonna diamond hand it.
I understand that, but let's say that person owns 1 million shares and they want to pay taxes or, buy a car or something. They only want to sell 100 shares.
I don't see a problem with that. That's only 100 shares.
Okay, right, but they're going to make the price go down because they are now hurting the stock price. The million shares they own kind of are more of a liability than an asset because the only thing they could really do is make the price go down when they sell. And in fact, they're going to have a disproportionate impact on the price because you guys own the float. And when they sell, their shares are some of the only shares left trading. So you kind of have hurt yourself, I think, by cornering this stock. In fact, if you look at how the corners have worked, they generally don't. Nobody's ever cornered a stock. It's never actually worked in the history of finance. Markets have been around for 300 years. I think the thinking that some people have is like, it's magical thinking, and I don't know why. I mean, some people buy, like, the cost of admission is worth, it's honestly worth to many people the entertainment they get out of it. Because they think they're sticking a middle finger up to Wall Street or something, but the funny thing is, Wall Street sticks one right back out. I heard a rumor of how much Citadel lost on GameStop. Some people think Citadel made money on GameStop. Does anybody think that? I'm not supposed to talk about this either. Very much not supposed to discuss this matter. Maybe it is public. How much did Citadel lose on GameStop? It's a big number. Big number. I mean, Citadel's still in business, still doing fine, right? So you can guess, but they didn't make money on GameStop. They didn't make money shorting GameStop or doing payment order flow. But I think that markets are a little bit weird. Like, so take quantum computing, for example. This is going to sound a little like voodoo and like technical analysis, so you got to bear with me and just take this with a grain of salt. Yeah, they did not make money on GameStop. Citadel lost a gigantic amount of money. One of the things about markets is that they're really effective tools. They kind of work, I'm not going to say they work on a supernatural level, but I will say that the outputs of markets as machines, they're not neural networks, but they're machines. The outputs of lots of machines are surprising. Neural networks can output natural language. It's incredible. Markets output something it's a process or a machine that outputs something really interesting. One of the things that markets seem to sense is weak positions. So at the time of the squeeze, so to speak, GameStop, there were a lot of hedge funds in trouble shorting the stock, and they basically had to capitulate or they would suffer sort of either permanent loss or a really large drawdown. And neither are particularly good for the hedge fund, for having a hedge fund business. Your clients don't want to see you have erratic ups and downs. You guys know, many people poke fun at me. I'm having very much right now an erratic loss. But I'm not a hedge fund. I don't have clients. I don't particularly care about my month-to-month performance. I care about how I do at the end. I do care about permanent loss because if I have permanent loss, I don't have any capital to make it back. So I have to adjust my position sizes to kind of roughly allow me to stay in the game without, being crippled. And even being right on the trade, you still don't make any money on it. So I think that one of the things that markets can sense is the pain of each side of the trade, which some people call max pain or max pain theory. Some people even have formulas for calculating what is max pain, but it's not really determinable. You can feel it out if you're a really good trader,
Also, if you have your ear to the ground and you're talking to lots of funds, you can feel it out too. You can look at the short interest a little bit and see if there's been capitulation. And sometimes there's pain, but not capitulation. Sometimes there's pain and it seems like it's going to have a capitulation. So it's really hard to tell. When you whisper, well, you know, the hedge fund industry is composed of people. We talk, we gossip, and there's a lot of discussion about who's losing money on a trade or who has a big, bold trade they're making. Oh, I heard, you know, I don't know, Millennium is short 5 million shares of IonQ. Oh, I heard they're going to fire the guy that did that. And, you know, they're going to have to buy 5 million shares of IonQ. You know, there's that kind of idea. So I think that markets can sort of sense these sometimes, but in other ways, markets don't particularly care. In the long run, the process of the market, you know, kind to take a 𝗦𝗛𝗓𝗦𝗧𝗏 quote, the market weighing machine is a process that runs concurrently with the market Max Payne machine. So to me, I feel like, again, the rhythm of these trades is really interesting. Some people are really in tune to them, and they really have this gut feel. To me, I like to override my gut feel a lot and just go with the weighing process machine, especially because I don't manage other people's money. I feel like, you know, what do I care? I can be down 10% in a month or more, as long as I feel comfortable what I'm doing isn't crazy. It's an interesting kind of way to do things. No, Christopher, I'm talking about increasing positions and being unafraid of mark-to-market losses. You know, other traders have to flinch and capitulate, but I can afford to flinch last, but even I have to flinch at some point. I haven't really begun to raise more capital for the trade, but I'm confident I could raise quite a lot for adding to this trade, but I could also use other resources I have, which I haven't done quite yet. So I have some breathability if it goes to, if these stocks double again, you know, I could survive it. I am heavily short QUBT, yes. You are never supposed to add to a losing position.
Tips on getting better at trading. Tip number 1, make sure you make the smallest positions you can. Most people use way too much leverage, way too much cash. Always keep cash. Tip number 2, notice the habits you have. If you're always in stuff early, leave a little room to grow your position. If you're always late, try to get there faster. You know, keep a trading journal or something like that. Best thing you can do is work with somebody. If you have a person you're working with closely, they can kind of talk you through some of these things. Someone you trust, someone who's also good at trading. You have complementary strengths. I think Snowball sets you up and is a really good appetite. You know, gets your appetite going for investing. Yeah, just being honest with yourself. I think the best book about this is Trading to Win by 𝗟𝗓𝗓𝗦. I mean, if you're looking for somebody who will work with you and trade with you, I mean, there's a couple of people who could do that. I mean, there's people in Godel, but basically you got to either commit to being a professional investor or not. You know, if you're not committed to being a professional investor and working with someone daily about, you know, your transactions, I don't know what to tell you. Charlie Munger was the best thing that ever happened to Warren Buffett. Not because Munger was better than Buffett. Munger was there to be a stable counterpart to Buffett. Buffett, you know, could get excited, want to do trades and transactions, and he listened to Munger because Munger could keep his cool no matter what. Buffett was the real genius, but Munger could really keep his cool, and he could tell the psychology of what Buffett was getting into. So, you know, having him next to him for every transaction, was Munger's ability to tell him not to do something really kept Berkshire out of trouble. And staying out of trouble is the first thing you got to do when you're an investor. Doesn't matter if you're a trader or an investor, or both. Private equity, none of that matters. You know, if you can avoid bad transactions that are like permanently bad, kind of that's what I really focus on. you know, I try not to get into situations where the permanent, forget the market spirits for a second, but the permanent value of the company is divorced from what I paid for it or what I speculated on it. For example, why quantum doesn't worry me is because I have a very strong feeling that the permanent value of these companies is very low. So they can mark it up, they can mark it down. It doesn't make a difference to me because I feel really confident in that. If that changed, you know, then I'd get nervous. If QUBT all of a sudden went from 35,000 in revenue to 3 million in revenue, I would say, wait a second, maybe I was wrong. If IonQ CEO started buying stock instead of selling it, I would get nervous. But the permanent value changes are what upset me. So for Sarepta, there's no doubt that the value of ELEVIDYS has permanently changed. It's less. And I don't like that because, you know, I bought a stock thinking it was worth X, and now it's worth X 0.95X or 0.9X. And that's really frustrating because, you know, it's like I lost money in essence. The mark to market, of course, shows what it shows. You know, I think what's more important when you invest in this style is what is the true value of the company that you believe in. Now, if you're at a hedge fund or mutual fund, or you have a wife, none of this stuff matters because people care about the P&L today, and you're playing a different game. Well, there you have it. I mean, it's typical face saving. I mean, he said the magic words, which if you guys are new to this industry, you might not know. But when a company says they're partnering the drug, that means that they're giving up on the drug. If they're going to advance it with a partner. Problem is, who in their right mind would partner? 𝗕𝗢𝗓 Therapeutics, maybe? I mean, it wasn't a terrible thesis. I think that, you know, there are worse theses out there. But, yeah, drug development's hard. We tried to warn everybody, and unfortunately, a lot of broken hearts out there. But next time, maybe you'll listen. Unfortunately, people really feel like there's some ulterior motive. Like, I'm trying to get you to lower the stock price by you selling your 500 shares. That's not going to help me. It doesn't make my bet easier. It actually makes my bet harder. I'm actually trying to be a nice person. But the assumption is, who would go out of their way to help me? It must be a ulterior motive. Despite doing this now for like 20 years, as transparently as possible. Yeah, I mean, there's no benefit in the subgroup whatsoever. That whole thing is a joke. Anders research. Another failed Alzheimer's drug. Trial failure not totally surprising. But the lack of a real serviceable spin definitely is. Good game to all. Made many friends along the way. On to the next. Well, I don't know what friends you made, but you certainly didn't make any friends with me and my group.